Have you ever wondered where the money in your bank account truly comes from, and how it connects to the money created by governments? It might seem like a simple question, but understanding the different forms of money is key to grasping how our modern financial system operates. At its heart, the primary difference lies in who creates the money and what it represents. Commercial bank money is the digital money created by commercial banks when they issue loans, while central bank money is the foundational money, often called base money, created and controlled by a country's central bank. Let us break this down further. Central bank money exists in two main forms: physical currency, like the banknotes and coins in your pocket, and digital reserves held by commercial banks at the central bank. This central bank money is often referred to as high-powered money or the monetary base because it forms the bedrock of the entire financial system. The central bank has a monopoly on its creation and uses it to implement monetary policy, aiming to influence interest rates, inflation, and overall economic stability. When a central bank wants to increase the money supply, it can create more reserves and use them to purchase assets from commercial banks, or it can lower the reserve requirement for banks. On the other hand, commercial bank money is mostly digital. It is what you see as your balance in your checking or savings account. This money is created when commercial banks make new loans. For example, when a bank approves a mortgage for a new home, it does not transfer existing central bank money. Instead, it creates a new deposit in the borrower's account. This new deposit is new commercial bank money. The bank then has an asset, the loan, and a liability, the new deposit. While commercial banks hold some central bank reserves, they do not need to have a one-to-one backing of reserves for every dollar of commercial bank money they create. This system is known as fractional reserve banking, allowing banks to create for more money than the central bank reserves they hold. The interaction between these two types of money is crucial for the flow of credit and liquidity in the economy. For you, the everyday person, this means that most of the money you interact with daily, your paycheck, your debit card transactions, your savings, is commercial bank money. When you deposit money into your account, you are essentially adding to the stock of commercial bank money. When you withdraw cash from an automated teller machine, commercial bank money is converted into central bank money, specifically physical currency. Understanding this distinction helps clarify how monetary policy works. When the central bank adjusts interest rates or engages in quantitative easing, it primarily affects the amount of central bank reserves available to commercial banks. This, in turn, influences commercial banks' lending behavior and their ability to create new commercial bank money, ultimately impacting broader economic activity. The central bank acts as the ultimate guarantor and regulator for the commercial banking system, ensuring stability and confidence in the value of all money. The interbank market, where commercial banks lend reserves to each other, is also a critical but often unseen component of this dual system, facilitating liquidity and risk management. Recognizing that commercial banks create the vast majority of the money we use daily, distinct from the foundational money created by central banks, provides a more accurate picture of our economic landscape. It illustrates the powerful role commercial banks play in credit creation and highlights how central banks, through their control over base money, ultimately steer the broader financial system toward economic goals. This dual structure is fundamental to understanding modern economics and finance.